In this video, I will walk you through on how to sell call. Particularly we'll be walking you through just the covered call. Writing options contract needs bit more understanding. I will explain all of them in this video with theoretical and practical application. Before getting to know about covered call, I would like to introduce to option Greeks. Yes, as the word says, it's little bit tricky to understand these terminologies. But, once you have the basic idea, it should be easy to stitch things together. But here, I am not going to go through all the Greeks. I will be just touching upon the theta, which is very useful for making the covered call decision. Though, it's not the only metric which should be used. So, what's theta? Let's dive into it. In previous video, I had talked about time decay. That's called theta in option Greeks. It might sound as simple. We need to understand how the value of theta is derived and how it might impact the way we sell our covered calls. How is time decay calculated? It's the strike price minus current price divided by number of days. The strike price is the price at which the contract is made. Number of days is the duration of the contract. Let's take couple of example. For the strike price $100 when the current stock price is $90. Let's vary the denominator, which is number of days, and see how the decay works. For a 9 months contract, it decay by 3 cents per day. For a 6 months, 5 cents per day. For a 3 months 11 cents per day. So, you get an idea. The shorter the duration, the faster the decay is. Let's take this chart. Have split the region into 3 sections. If you see, the section 1 which is far away, the value of option price decreases approximately 10%. But in section 2, almost 20%. For section 3, it almost drops 70%. This is just a reference and not the actual percent. Not just the contract duration, but selecting the strike price also impacts the decay. What if the strike price is just $1 above the current price? The decay will be fast. Basically selecting at the money contract decays fast compared to in the money or out of the money contracts. Let's see the Apple options contract. Take the contract which is 7 days to expire and, for the at the money contract of $132 or $133. The theta value is 14 cents per day. But if you take a contract which is expiring almost 9 months from today, the at the money contract price of $130 or $135 decays by 2 cents per day. I would like to make a note here. The farther the period you go, the contract can't be made very granular and the deviation will be higher. Which means selecting the strike price have to be done accordingly. At the same time, the out of the money contract for strike price $160 which decays by 2 cents and $180 which decays by 1 cent. Hope you were able to correlate the formula, graph and the actual contracts. What's the key takeaway in this theta? Time decay is the rate of change in value to an option's price as it nears expiration. At the money have more decay than in the money or out of the money. Option sellers can use the power of this decay to collect premium. But it's not the only metric to rely on, as I said earlier. I will focus on the other metric in future video. Now, let's come back to understand the core of this video. The covered call. What is a covered call? It's a transaction where the seller owns the position for which the contract is made. And in case if it needs to be exercised by the buyer, the position is covered. Let's say the seller here owns 100 Apple shares. Then the seller can write one call contract, which the buyer can buy. The 100 Apple share is called the covered position, and the one contract which was written is called the covered call. Now you know what is a covered call. But, why do we need to sell covered call? Let's see the use case. 1. You can use it for generating income from your existing investment. 2. Hedge against a position. In this case, 100 Apple shares are your existing investment or position. Now, we have a use case. But when is the time to sell a covered call? There are a couple of cases where you can sell them. When the stock is overbought, or overvalued for the current earnings. Or, when there is a temporary bad news against your position. But you don't want to sell your holdings, rather make some money out of it. One of the technical indicator, which can tell you if the stock is overbought, is RSI. Relative Strength Index. It's a very simple indicator, lots of traders use. Let me show you the Apple shares in last couple of years in a day chart. This is the RSI indicator. You can relate the RSI greater than 70%, which is typically considered overbought, and compare them against the Apple share price at that time. So, you got some fair idea about it. A quick recap. Now you know what is theta and RSI. Theta, which is the duration, and RSI, which is the right time to sell. Combining together, you should be able to sell a covered call for a particular duration and at the approximate right time. When I say approximate, yes, I mean it. Since no one can predict the future. These are all the metrics and indicators, which can guide you. But, finally, it's individual's call to select based on your risk. Now, let's look into how to apply those learnings into selling the covered call scenarios. Generate income. Typically, if you want to constantly generate an income, select the short duration where the decay is very high. It could be a weekly or monthly call options. For the time, look for when the RSI goes to oversold state and write a call option. When to sell is a big decision. Let's dive deeper into it. Remember the case 3 in part 1 of this series? We saw where the seller is selling a call option assuming the Apple price will drop or stay at the same price. The seller sold the contract on December 23rd for a strike price of $130, with an expiry date of December 30th. Since we already know what happened, let's look into the actual data in Webull. See, here the price was around $132 on December 23rd. But on December 30th, it was around $127. The seller's assumption was right and the seller walks away with the premium and also holding the 100 Apple shares still. The seller can again write another covered call to collect the next premium, but this time the seller will go for different strike price and duration and also will wait for the right time. Remember this chart from part 1? The covered call is always written when the seller is neutral or bearish on the stock. Let's go back 2 years to see the Apple stock value. I want to show you how Apple stock performed and how many times you could have written a covered call. Assume you bought Apple stock 2 years back at $134. As of today, the price is still the same. So, your investment never gained any in last 2 years. Since Apple stock has got dividend, probably you might have made some percent of dividend on that stock. But what if the stock you are holding don't have dividend? Then, you probably didn't make any money for 2 years. What if you can make money using those investment, but without selling your position? That's where these covered calls are useful in generating income like dividends. One thing to note, even though you are writing covered call, since you still hold the position, you will still receive the dividends. So, double income strategy. If you see here, there were 6 times where the Apple went to oversold in last 2 years. And also you can see the duration in between was close to 2 or 3 months. This gives a really good idea on this stock and what duration. Average you can get around $500 per contract for 1.5 months to 2 months. Which means you could have gained $3,000 in last 2 years. Is this not a good strategy with low risk? Absolutely. It's a good strategy with low risk if you pick the right strike price and duration. Few ideas here. Say, if your cost basis is less than or equal to current price, then you can do at the money covered call. Since the worst case if the stock goes up, you still keep the premium. Here, it's just that you have limited yourself to less profit. If you are writing a covered call when the cost basis is greater than current price, to be on the safer side, you can do out of the money strike price, which will either give you a less profit. If the cost basis is well below the current price, then you can even do in the money to collect more premium. But here, you need to for sure that the strike price will expire out of the money, else you will have to give up your underlying holdings if the buyer decides to exercise. Now, let's look into scenario 2. Hedge a position. There are multiple ways to hedge a position. Some of them will buy a put option, but this will have the decay against your favor. But, if the stock really falls deeply, this will give you a high return. Similar to that is selling covered call. Here, your premium is locked. And also, the price decay is in favor of you. Hedging is mostly done based on bad news. In March 2020 the market crashed due to COVID outbreak. This will be good time to hedge your position. The duration you select is also based on the type of news. If you think that recovery will take more time, then you can even go for a long term, since the premium will be higher. Hope you got a good picture of option Greek theta and the covered call. I will cover the rest of the option Greek in future videos with proper application. Let's now see how to place a covered call in Webull. It should be similar in other trading platforms too. Here, if you already have 100 stocks of Apple in your brokerage account, then you can just select the single option, select the contract date and strike price and sell them. In this case, we are selecting a contract 3 months away and selecting strike price $135. Here, we are going to collect a premium of $875. If you don't have any shares to cover, you can select the covered stock option here. Now, you can see the ask price. It's very high, since it's including the price of 100 Apple shares minus the premium you will be collecting. If you see here, for a $135 Apple stock price, the amount for debit is only $12,468. A different way to look at it also, here you are buying an Apple stock only for $124 cost basis. Which is cool, right? Let's wrap it up with few highlights. Covered call is good for below trends. Either it's a sideways trend, or it's a downward trend. And it's bad if the trend is upward or not recommended to write a covered call in this situation. Few tips to share. Select a low volatility equity like SPY, where you can predict the price direction to some extent to reduce the risk. Also, SPY has got lots of open interest, which is good for entry and exit into the position. Select a high volatile stock like Tesla, where you can collect high premium. Final thing, I just wanted to show what stocks are good to trade with covered call. As I showed you in earlier videos, bar chart will give you a good list of stock with good metrics, so can pick the stock to trade. Hope this video was very informative and practical, so you could stitch things quickly to the real-life trading scenarios. Hope you enjoyed the video. Please subscribe to my channel if you like to watch similar videos and help my channel. Thank you. See you in another video.